I'm just going to have you quickly and now introduce yourself to the audience, right? So that would be great.
Cool. Hey, everybody. Thanks for coming out. I'm Andrew Jewett. I'm the CEO of a company called Aperture. This year, we issued a token called Property Coin. Obviously, I think most of you probably are aware of the bloodbath that's been going on in the crypto world. So we were not immune from that. But what it was a fully securitized token that was SEC compliant. We've actually received a letter from the SEC validating what we've done, which is, I don't know, Marc, maybe you'd be able to talk about this, but very, very few people have gotten that. So something that we're very proud of. But we are a distressed residential real estate investor. We invest across the country. We view tokenization as a way for a different method of funding. And one that we really, really are excited about. We've been in this space for a long time, which is a relative term in the crypto world, but we're super excited about what 2019 brings. I think there's a lot of developments that are coming along, and I touched on it a little bit before, but I think the institutional interest in the space is really going to start to kick in 2019, and we're super excited for that. So that's our story. Super quick, but we'll continue to chat.
So yeah, I'm Henry Elder. I actually forgot to introduce myself to the camera, so I kind of did already introduce myself to you guys, which is great. So here's my second introduction. I told you guys about digital asset advisors. Our first client that we worked with was a company called Slice, and we tokenized an LP equity interest in a commercial development project in New York, in Chelsea, in the spring of this year. And so I'm going to talk a little bit more about that later on tonight and kind of take you guys through that experience and what we learned. But I got to say, I agree a lot with what Andrew's saying in terms of why I'm so excited about being in this space right now, because we're moving from single asset tokenizations into a more interesting space where people are raising funds and people are raising REITs. And those are the types of institutional products that will foster the creation of a liquid and very deep secondary market. And that's exactly what we need.
I'll also repeat my story. So Marc Boiron, partner at FisherBroyles. So I've been, I guess, working in the STO space with probably, 10 to 15 clients generally at once. And ranging kind of across all industries, and so real estate's just one of them. Henry and I worked together on Slice, and so I was handling the U.S. component. We had foreign counsel as well, so kind of just been working on different offerings, whether it's Reg CF, Reg D offerings, Reg S offerings, so a little bit everything across the board.
So I forgot to ask, just so we can get a sense of who's in the audience, just by a show of hands, how many of you are maybe working on that STO deal now? Just curious. Yeah, on the launch. Oh, that's great. Wow. And how many of you are in the blockchain or security token space? Okay, most of them. How many are in the real estate space? Good crowd. And any newcomers? Not that we're trying to out you or anything. It's like we are trying to out you. But welcome. Great. So let's get started. Just for some of the newcomers, Andrew, can you start out kind of explain to us what is real estate tokenization?
That seems like a loaded question. I mean, there's so many different aspects of it, right? It's probably the simplest way to think about it is you're basically tokenizing an asset, and tokenizing an asset means creating a fractional ownership of some level of an asset. In my case, we basically tokenize the LP certificates of a GP/LP fund. You could probably say that's probably the easiest way to do it for any type of asset, but you could, in theory, make a token out of any share of any asset you want. It could be art, could be real estate, could be that chair. But that's the beauty of tokenization of anything. And I think real estate, obviously being the single largest asset class in the world, lends itself incredibly well to that. But really all it is taking a digital token and making that represent a share or an ownership interest in some asset. In this case, we're talking about real estate.
So why are we applying real estate to the blockchain now? Like what's happening? Why now?
I don't want to answer all of
Yeah,
it.
yes.
Well, so I think it grew out of the explosion of the ICO last
makes
year.
sense, right.
That sort of woke up people to the fact that blockchain represented a new capital market. And you could use that capital market to capitalize any sort of a deal that you wanted.
Right.
Now, a lot of that capitalization happened under a non-compliant structure.
Sure.
But people started realizing quite early last year, I mean, in March you saw the blockchain capital raise,
Yeah.
that there was a compliant way to tap these capital markets. And so I think that it took some time to iterate through the various ways that you would do that and come to a successful structure to tap those capital markets in a compliant manner. Also, ICO mania sort of set us back a little bit because people got used to 10x returns in a month. And you tokenize a hard asset, and realistically the value of that token should track the value of the underlying asset.
Sure.
Which means that if it's a fund or it's real estate or whatever, you're going to get a 15 to 20% IRR, and you're not going to get your 10x return.
Exactly.
You know.
Just to add on to what Henry said in terms of how things came out of the ICO kind of boom, you know, it's one of those interesting things. Things are starting to change, but conversations, you know, at the beginning of this year around STOs, and even a little bit later, and frankly even 3 months ago, were so tied to ICOs, both in terms of expectations of returns, but also in terms of like, is an STO compliant? Like, or the questions like that, and it's like, well, or can you do an STO? And those questions, frankly, if this didn't come out of the ICO world, you wouldn't have ever had those questions because it's just a securities offering. I mean, it's literally that simple. It's just offering a security. Just look at the securities laws that exist, and that's what you're going to do. So just kind of an interesting point that a lot of the confusion's coming out of the ICO world, and I think that can be forgotten when you're dealing with STOs. It's a totally different animal.
Yeah.
It should be forgotten.
That's right. I think one of the best analogies I've heard to describe an STO is that it's like you're going shopping at the supermarket, right? And instead of taking your asset, which would be your groceries here, and putting it in a plastic bag, which would be a traditional paper security, you're tokenizing it, which is like a reusable bag. You're not changing the nature of the groceries, the asset itself. All you're doing is putting it in a different, better bag. That's all it is.
That's great. I've never heard that. That's good.
Yeah.
That's why.
Well, now you have.
That's why we invited you. So there's so many different real estate asset classes. There's land and apartment buildings, commercial property. What can be tokenized?
Anything.
Yeah.
I mean, literally anything can be tokenized. And now the question is, what should be tokenized?
What should be tokenized?
And I think that's going to change with time. I mean, right now we're at a point where, you know, tokenizing the simplest thing possible is probably the best idea, and both the simplest asset, but also in the simplest manner. And so, you know, REITs are not necessarily simple, and neither are funds, but when you're talking about tokenizing them, those are probably some of the easier things you could tokenize. Now, when it comes to real estate, some of the things that I think we're going to see down the road and is kind of exciting are going to be very different from what you're seeing now. I talk about right now we're in a brute force world where you're forced to take the asset, stick it in an entity, and then tokenize the interest in that entity. It's not very pretty for somebody personally who loves blockchain and you know, decentralized technology. Like, it's not really all that much fun. The day where we can actually do it, it's just difficult, and so we're not going there yet, tokenize the actual title to the property and actually have that directly owned. And there's reasons you wouldn't want that for legal reasons, from a liability protection purpose. But once we figure those kind of issues out, and legislation will be required, there's going to be a whole direct ways to actually own real estate in a much more interesting way than we're doing it now.
Yeah, you kind of preempted my next question. So exactly, Marc, what are we tokenizing, right? Are we tokenizing the deed? Are we tokenizing the entity that owns the deed? What's being tokenized?
I mean, right now what you're seeing consistently is you're tokenizing the actual equity. Is you're taking a property, you're putting it in an entity, and then you're tokenizing that share. And what does tokenizing a share actually mean? Well, really, the thing to remember is the token itself, when you're doing that, is really not the security. The security is the underlying share. You still have a share.
Yeah.
And when somebody says, like, I personally, I don't like seeing like a token purchase agreement, because that's like ICO world. We're not. It's still just a stock purchase agreement. It just happens that your stock now lives on a different ledger.
Right.
Instead of a while ago it lived on a paper ledger, then you moved it to an Excel ledger, then you moved it to an electronic centralized ledger. Now we're just moving it to a decentralized ledger in terms of a blockchain. That's all we're doing. The underlying asset security is the same. It's still just a share, and that's what's been being tokenized in the real estate world for now.
You know, the other thing that people always ask is, oh, can we tokenize this? Can we tokenize that? And the answer is yes. But the other answer is, like, should you? And you have to realize these are investments too. Like, people, you know, I think a lot of people just got so crazy last year about, oh, you know, I can make 10x in a month. But, you know, when you tokenize assets, you have to look at the asset, and does it make sense as a deal? Does the operator who's issuing this token know what they're doing? Does the building that they're tokenizing make money? That is still in the conversations that I have sometimes, people still aren't. They think of blockchain and tokens as this panacea of, like, oh my God, there's just so much liquidity and this, that, and the other thing. It's like, well, yes, that's true, but there also has to be an underlying good deal to it. So just another thing to think about when people are, you know, talking about tokenization or talking about real estate tokenization. It's, you got to look all the way through to the underlying deal, because that's, you know, ultimately this is an investment.
Great answer. I have a question. So a few years ago, there was kind of a proliferation of kind of real estate crowdfunding platforms, like I think Patch of Land or what have you. How is real estate tokenization different from that?
Well, so those platforms were very interesting and very innovative, and they all came out of the 2012 Jobs Act, right?
Yeah,
Which
right.
basically the goal was to democratize access to those types of deals. But the problem was that they could not offer any sort of liquidity to the deals that they were that they were crowdfunding.
Right.
And so I look at tokenizing maybe a little bit as a crowdfunding 2.0 that potentially could realize some of the promises of crowdfunding 1.0.
Okay.
But I don't think that that's necessarily the story that we should focus on as we move into the real estate tokenization space. And so, yeah, I mean, you would invest into a deal on, Realty Mogul or Fundrise or Patch of Land or any of those websites. And I was actually on both sides of many of those transactions. I brought them deals, I funded some of their deals, and they funded some of my deals. But the problem was that you would put this money in and it would just be locked up for 5, 6, 7, 10 years. You wouldn't know when the liquidity event would be. And then, maybe every quarter there would be a window where you could liquidate your shares and get them back for like a 10% haircut or whatever. It just, if you're someone that is putting aside $100, a week or a month to save up to invest into something, well, you need that money to be liquid, right? Because life is unpredictable, and if all of that money that you're saving up is tied up in something that you can't pull it out of, well then, that's not a very prudent investment for you.
Right. Interesting. I know, just switch gears a little bit. 2018 has been like a hard year for blockchain, for crypto. It's a crypto winter. We see the SEC ruling saying pretty much all tokens are securities. We see the SEC going after some ICOs. We see scammers out there. I guess my question to you guys, you're kind of in the thick of real estate tokenization. Has all of this negative news impacted real estate tokenization? And if so, how?
Absolutely.
Yeah.
So when we tokenized this property with Slice, we went out and the goal was to create a conduit for international investors to invest in domestic deals.
Right.
And we went out to these investors, and okay, so first of all, there were two expectations. One was that there would be a wall of crypto money that would just flood in because they would love these less volatile assets that were not correlated to cryptocurrency prices. And that didn't materialize,
right.
Number one. And then we went out to real estate investors and we said, hey, we have this great new way to invest in real estate. It's tokens, they run on the blockchain, you're gonna have liquidity, it's gonna be cheaper for you to invest. And they said, blockchain, that has to do with Bitcoin. Bitcoin is money laundering. It's all criminals. I don't think I want to do that, you know? And it's just that fundamental mismatch between real estate, which is a very conservative and slow-moving industry with wealth that is created over generations, right? And crypto, which is super fast-moving, and you're poor one day, you're rich the next day, and you're poor again the day after.
That's great. Did you want to add to that? All right, yeah. No, that's very interesting. So where are we now? Like, how are you? I don't know. How are you talking to traditional real estate investors, real estate buyers now?
I think we're at an interesting inflection point. We're personally, for us, we're getting a lot of inbound calls from large investment banks, big private equity and venture funds, kind of. I think that the reason why for us, and I hope this is true, is that we are sophisticated investors. We worked on Wall Street. Our background is in investing in real estate, but we also attempted to do it the right way. We spent a lot of money on legal. We spent a lot of money on AML, KYC setup. We kind of covered all bases, and you're starting to see the weeding out of the guys who didn't do that correctly. So I think you're really starting to see some of these big institutions start to take a good hard look at what's going on, because I don't think they understand it yet, but they're really starting to look at it, and that's what's really exciting to me about 2019. And if we're honest, banks don't move quickly, and venture funds might, and private equity funds might, but I think once you start to see the big banks start to adopt this, and they're starting to, but it's a slow process. You'll start to see that divide, because there really is a big divide between everybody in this room who kind of sees the future and what we all think it could be, and what I think the institutional money really thinks it could be. And so, the economy is not, or the markets are a little shaky right now in general anyway. So it's a challenging time, but people are starting to really take notice of this.
That's great.
I also think there's a lack of understanding by institutional folks of the technology itself. So everyone reads about hacks, losing some kind of crypto, and the institutions think that can happen to them too if they're holding a security token. And I'm not sure if we're going to get into it later, but there's tons of ways that we're dealing with security tokens to eliminate that issue. And most of that all comes down to kind of the compliance protocols that you're building into the token, and how you actually code the smart contract. And what if I was going to pitch institutional folks, I would simply say, hey, you know what I'm going to do for you? I'm going to create this wallet and a smart contract and this token, and I'm going to give it to you. And if you want to ignore it, feel free to ignore it. It literally doesn't matter, because if you lose it, you're just going to tell me that you lost it. And I might ask you for an affidavit that says that you lost it, and then I'll just give you a new one. And you can lose it again if you want. I really don't care. But for anyone else who wants to use it, well, go ahead, transfer it. You'll have some liquidity that you didn't have otherwise, and your risk is nil. It's no different. But that requires them to actually understand the technology and how it works, and the position that issuers are taking with respect to the security, and how carefully compliance protocols are being built to be able to ensure that you don't just lose your security token.
Yeah. That's a good way to kind of describe it, and talk to institutional investors about it. So I have a question for you, Marc. So let's say if I want to do a STO real estate deal. I mean, there's so many different regulations out there. There's Reg A, A+, Reg CF, Reg D. It's like A, B, C, D. Yeah, so many different regulations. Can you just maybe give us a brief overview of the regulations, what regulations apply to real estate tokenization?
Sure. So I mean, there's as you indicated. There's a ton of different regulations you could look at.
Right.
And so the way that I kind of think about them is going from the accredited investor-only options to the unaccredited investor options as well. So the traditional tool that was used really before crowdfunding and even during crowdfunding has been Reg D, but 506B. There's 506C and there's 506B. 506B is basically you're not going to have a general solicitation. You're only going to reach out to unaccredited investors. The securities are going to be tied up for 12 months. You're not going to be able to transfer them, but you can raise as much as you want. Then the Jobs Act created 506C, and 506C allows a general solicitation. The exact same thing as 506B works the same way. The only difference is instead of getting a representation saying that you're an accredited investor under 506B, in 506C you're actually going to check and make sure that they're accredited investors. And if you've done that, then you've complied with 506C if you comply with the other things as well. But that's the only difference. You can raise as much as you want, and you can go raise from the world. And one thing that as a side note that's misunderstood is you can use Reg D internationally as well. You don't have to use Reg S. Okay. Just a side note there. Sometimes it's just easier to do that. But anyway, so then you kind of move on from there and you say, okay, well, maybe I want to include some unaccredited investors. Well, one of the exemptions that's not talked about very much also falls under Reg D is 504. 504 allows you to raise $5 million from accredited as well as unaccredited investors. And the difference there is you can't have a general solicitation. So if you're going to do a 506B, but you want to include unaccredited investors, then you might rely on 504. Problem with that is it doesn't exempt blue sky, so you need to comply with all blue sky laws, as in all state laws.
What are blue sky?
Yeah, sorry. So it's state securities laws.
Okay.
So you're going to have to comply with state securities laws, which could be an issue if you're dealing with many different states.
Yeah.
Then you move from there and you say, okay, well, we want to actually crowdfund from non-accredited investors. And so you go, well, what's the biggest way we can do that? And you're going to do that through Reg A+. Reg A+ got two different tiers, Tier 1 and Tier 2. Let's not talk about Tier 1, essentially never gets used. Tier 2, you can raise up to $50 million. You can do that from accredited as well as non-accredited. You can go ahead and market the offering. The nice part about Reg A+ is your securities are immediately transferable afterwards. One misconception that I should note is the concept of a transfer agent. You're going to hear over and over again that you need a transfer agent in a Reg A+ offering. Uh-huh. That is absolutely not true. Okay. The only reason why you want a transfer agent in a Reg A+ offering is it then exempts you from what's referred to as 12G, which is a limitation on the number of stockholders that you can have before you need to become a reporting company. But you don't actually need a transfer agent, and there's certain situations in which you might not want them. Last point on Reg A+ is that it exempts blue sky laws, so state securities laws, in the primary issuance, but doesn't do that in the secondary trading of those securities, which is an issue. The last one I'll mention is Reg CF. Reg CF lets you raise $1.07 million from accredited as well as unaccredited investors. Unlike Reg A+, which needs to be qualified with the SEC, by the SEC before you can actually start offering it. So it's a pretty elaborate process. Reg CF, you just file a Form C and an offering memorandum, kind of like you do with a Reg D, which is just do the filing and then go ahead and do the offering. That has to be done through a crowdfunding platform. There's several of them in this area. One, Start Engine, is great, and there's a lot of other ones. So bottom line is those are kind of broadly kind of your exemptions that exist out there. You can also do a registered offering if you really want to, which is kind of become a public company. But that's usually not an option that people choose to use.
Yeah, and I'm just curious, what regulation are most real estate STO deals doing? Do you know me? Yeah.
So.
You did, D. Okay.
Yeah. A couple thoughts here. One is that although Marc is a brilliant lawyer, he's not your brilliant lawyer. So make sure you get your own counsel. Just putting that disclaimer in there. And Reg A+, I'm glad you mentioned that because Reg A+ is sort of like the holy grail of fundraising in the crypto world. Sure. But the SEC has been moving very cautiously when it comes to Reg A+'s and has not qualified any of them. So pretty much everything that's happened so far has been under Reg D. To answer your question.
Henry, this question is directed at you. What are the major differences you're seeing between U.S. domestic and foreign real estate tokenization deals?
So one way I would say is that most of the U.S. deals are getting done compliantly.
Okay.
In a way that in a way that doesn't blur the boundaries.
Right.
I have seen quite a few interesting deals internationally that still kind of believe that you can use a utility token model.
Right.
The problem with that, the problem with that is that real estate is one of the easiest assets for regulators and lawmakers to regulate, right? Because that asset's not going anywhere.
Yeah, right.
And so you can lose control of your real estate deal quite easily
Right.
if you're not complying with regulations.
Right.
And so I think that there is a benefit to pushing the boundaries in certain instances, but I don't necessarily see it in those instances.
Yeah.
Just, one of the things that that was a lot of people told us, or a lot of people kind of questioned us as we were doing this, and in a compliant or attempting to be a compliant way last year, was like, well, why don't you just do it the right way and beg for forgiveness? And I just
From a federal penitentiary.
Yeah, well, exactly. And it's like, oh, well, Uber did it or Lyft did it, and they just kind of bullied the unions and they bullied the state regulators. And it's like, you cannot Uber your way through the SEC. The SEC is the government. Like, they will come after you. And I said this to, pretty much anybody who would listen. It was like, I like living in California. I like living in the United States. I don't want to be in my boxers being dragged out by the guys in the windbreakers at 2 a.m. Like that's just not. I think there's enough disruption and there's enough kind of innovation in this technology as it is that we don't need to break the law. Like we need to do this in a compliant way, because it benefits everybody else down the line to do this the right way. So we just need, I've said this to these guys all along, it's like we all need to kind of help each other do this the right way from the beginning. Otherwise, we're going to lose the potential of this tremendous technology that we all have at our fingertips. And so, I welcome kind of anybody who wants to talk about it. I'm happy to help and kind of give advice and input on how we did it, because I want to see this industry succeed, and I want to see the blockchain change the world. But there's been a lot of bad actors, and so we just it's kind of incumbent on all of us to practice the best practices out there. So.
Right. Hey, so just as a side note, I mean, sometimes I hear people say, hey, as far as fractional ownership, you can own 10% of a property in New York, you can own 10% of a property in Shanghai, or what have you. But it sounds like we're still in the conceptual stage of being able to own fractional ownership in different parts of the world. Would that be correct?
It's early days.
Yeah, it's early days.
It's definitely early days, and there's also an interesting restriction, since these are securities that are typically going out under Reg D or
Sure.
one of the associated Jobs Act regulations, where you can really only split whatever the equity is into 2,000 pieces.
Okay.
Because if you have more than 2,000 investors in your cap stack, then you end up becoming a public company.
Yeah.
You basically hit a hurdle, and it triggers you, and you need to file a Form 10, I believe, right? And start reporting as a public company, and it just becomes considerably more onerous to comply with regulations. So everybody who's done it so far, they're only splitting it into 2,000 pieces.
Yeah.
And so for like Harbor's recent deal, right? They tokenized a student housing facility out in South Carolina.
Yeah.
Really cool deal. But once again, they were restricted to this $40 million cap stack had to be in 2,000 pieces, which meant that each individual token goes for about $20,000 a token, which, that's not accessible to a lot of people. However, it is more accessible than it otherwise would have been, because typically in a deal of that size, the LPs are bringing checks in the $500,000 to $1 million range or more, right?
Right.
That's actually kind of something I want to expound on a little bit more,
please,
because people are like, oh, well, it doesn't meet my definition of what constitutes a truly revolutionary change, which is not what we need to accomplish in order to see this become the standard way of securitizing things.
Okay.
Right? All you need to do is prove that it's better than the existing paradigm, which I think that we're proving every single day.
Yeah.
If it's 5% better or 10% better, and you're talking about markets that are in the trillions of dollars, that is an incredible amount of money that you're saving right there. It doesn't need to be 100 times better.
Right.
And I think that at the very least, tokenization is 5 or 10% better than the existing markets.
Right, right. Yeah, that's a really great point. You mentioned that over the last few months, we've heard about a lot of deals, Harbor and the dorm in South Carolina. I think there's a condo project. I think Propeller and Fluidity did.
Yeah, also in New York.
Yeah, I think it was the St. Regis Hotel. So we're seeing all these deals happening, which is exciting. I guess, I mean, I know you guys have a lot of experience. It would be great to kind of hear about kind of your battle scars, like doing an STO deal. What were your takeaways, and what did you learn, and maybe what would you do differently?
From my perspective, I think we were super early to this game. Probably a little too early for the market really to adopt what we were telling them. And as a result, I think we struggled with the traditional crypto investor. That they just, like Henry said, they just didn't get it. They didn't, if it wasn't a 10x return in 30 days, they didn't care. And you really struggle to get the institutional guys to really accept it. I mean, a lot of the conversations that we had with some of the biggest funds in the world said, I literally cannot buy this because I cannot buy an electronic security, like a digital security. It's just not in their mandate. And they said to us, like, we love it, we love you guys, we love the deal, but we just can't buy this. So there's got to be some adoption. I think what I would have done a lot differently is spend a lot more dollars on marketing and kind of going after some of these. It's hard to say this, but whales. I hate that term, but whatever. Going after some of those guys and getting some big checks up front versus the way we went about it. We tried to do it a little bit more, kind of general solicitation and get some groundswell that way. But I also think we were just way too early. There wasn't that market adoption, and there needs to be the bridging of the gap between the people who get it, everybody in this room, and the people who don't get it yet. So we're working on it. It's for us in particular, our business is not a do or die based on how we did our property coin sale. We've kind of put it on hold, and it's on the shelf, and I had a couple meetings today about it. So it's a constantly evolving process, but it's one that I think we're willing to take on the kind of the legwork of it because we see the future in it. And like Henry said, incremental differences are meaningful in this market, and so we want to be helpful and we want to be on the forefront of that change. But we've got arrows in our backs, and pioneers often have battle scars and arrows in their backs. But there's a lot of scars. But one I wouldn't change it for the world. So it's been a lot of fun. I'm continuing to be excited about this market. So it's slow moving now. That's kind of the bottom line.
That's good. Thank you.
I would say for us, we probably spent too much time focusing on the crypto market as well. What we found when we went internationally and started talking to more traditional real estate investors was that they were super interested in the underlying product, the actual commercial real estate itself. And we focused too much on the blockchain side of it. And so we actually had to go back to our website and our marketing materials, and we just pulled out all of the mentions of the word blockchain. We're still tokenizing it, it's still running on the blockchain, but there's really no reason that, it's, if you want the tokens, you can take the tokens. Otherwise, we'll just issue you paper shares, just like a normal transaction would. But we're still tokenizing properties, and we're still ready and waiting. Once the public awareness gets to that level, we just launch right back into the full form, hey, we're here, we're on the blockchain, it's tokenized, it's ready to go. But that's how we got our first deal done, and that's how we're continuing to get deals done.
All right.
I mean, this is similar to what I said earlier and similar to what Henry said, but bottom line is you're selling the security, you're not selling the tokens. And I think the mistake that everybody's making is they're going out and selling tokens. The easiest example I'll give is Reg A+. Reg A Plus offerings should not mention the word token. They shouldn't mention the word blockchain. Those are not material facts whatsoever. You're just selling a share. And then what you're going to do, and let me go back and say, have never seen a Reg A Plus offering that said, hey guys, SEC, I decided not to put my stock ledger on a piece of paper. I decided to put it on Excel. That hasn't existed. Now, most of it's because they use transfer agents, but leaving that aside, even if they didn't, nobody would ever say that. And same point is, why would you ever go out and scream, hey, I'm using a token? Why don't you just say, this is a share, and afterwards you're going to say, hey, by the way, my stock ledger happens to be on a blockchain. I mean, it's really that simple. So the point is, your underlying product needs to be good. That's what you're selling. And then, the investors will get the benefit of potentially having more liquidity on the back end. It's really what they might get, and it's great for them.
Right. So it sounds like tokens are like an ancillary benefit, right, versus the primary benefit, right?
I think with time,
Yeah.
it's going to start becoming more important.
Yeah.
Right now, it's an ancillary benefit, because right now, what we can't talk about right now is, hey, by the way, this is going to reduce the illiquidity or the illiquidity discount or by X percent. What we will be able to say with time is, hey, look at this trading, look how much more liquid it is, and look how it's trading compared to similar private assets when they actually are sold. And so with time, you may be able, and hopefully, I think you will be able to tokenize assets and sell them at a premium to what you would sell them without tokenizing them.
Right, yeah, good point. So the next section I really want to talk about is, I'm on LinkedIn, social media all the time, Medium. I read a lot of articles just, I guess, conceptually on how to tokenize and what's possible, what have you, but I still don't actually know how to tokenize. I just want to take a few minutes, and if you can just explain to me, just talk to me like I'm 8 years old, right? Like, how do you, maybe like A, B, C, D, how do you tokenize? And there's different real estate asset classes, so whether it's commercial properties or building, how do you tokenize? Yeah, so.
I could tell you how to do that, but when a client asks me, I say, I can tell you this, or you can call a Henry and he can walk you through it, and so I'll just give him the mic and let him walk you through it.
Thanks, Mark.
That was good.
I appreciate that.
Henry, you're in there.
You talked about the different asset classes. Frankly, it would be the same for all of them. And we kind of touched on this earlier, in that you're taking the asset and you're wrapping it in some sort of a corporation, an LLC, typically, and you're taking the shares of that LLC and you're basically putting them into tokens, which means that in your offering documents and your agreements with your investors, you're basically just, you put in there that the tokens represent their interest in whatever it is that the not in whatever the fund is, whatever the company is holding, but the interest in the company, and then the company owns 100% of the asset. Right. And then you go out and you find your lawyers and your issuance platforms and your protocols and your compliance platforms, and most importantly, you find your broker dealers and your distribution networks, because those are the people that are going to bring you the money to buy your tokens. And I think that is the most important thing that we've seen over the past 2 to 3 months, is that those networks have actually started to be built out. When Andrew and I were out there raising, those didn't exist. We were going and people were like, I don't know, what is this thing, right? And now there are these distribution networks and these broker-dealers that actually have syndicates of investors who are ready to go put money into tokenized deals. That just didn't exist at the beginning of this year. So I'm pretty bullish going forward, and I'm excited for what 2019 holds for particularly the real estate space, because we saw a lot of blockchain VCs do security token offerings last year and this year. That kind of seemed to be the main use of security token offerings. And I think that real estate has established itself as the
Yes.
the next big industry that's going to start benefiting from this.
Agree.
I got one comment. I might go the complete opposite way and say call a lawyer immediately. Like, do not say anything on LinkedIn. Don't say anything on Twitter before you talk to a lawyer. As somebody who literally
Kelvin,
just
take the microphone back.
yeah. But as somebody who just went through the SEC review process, I can tell you, if you're a lawyer, if you try to do this yourself, you're going to end up in a lot of trouble. And if you don't hire the right lawyer, you're going to find yourself in a lot of trouble too. And it has to be somebody with securities law issuance experience, and it has to be somebody who knows the kind of square peg round hole issue of tokenizing and securities law and how those mesh, because that was the primary area where we spent the most money, was trying to just mix those two concepts together. So I would say lawyer up, and then call Henry. But yeah, that's just mine.
And to just build on that a little bit, to me the key thing is find the one person that can quarterback this, who knows the ecosystem well enough to know all the players that you need. So if you've got the right person involved, they're going to know the lawyers that do this. They're going to know the tax advisors that are going to do this. They're going to know somebody in the real estate industry who can advise and who knows a lot of these players. Is very well connected, like Henry, who are going to know the broker dealers, who are going to know the compliance protocols that are out there, who are going to know the issuance platforms that are out there, who are going to know what exchanges are at what point in their development, who are going to know what market interest is like right now in different parts of the world, and then who's going to be able to connect you with each of those players. And then once they connect you, you need that same person to quarterback how you're going to go about this. So one of the things that often happens is early stage companies forget what typical early stage companies need to do. Actually get formed, issue equity. This isn't necessarily as relevant in certain real estate businesses as others. Have an equity incentive plan in place. Then they forget that they might want to kind of build a board of advisors of some sort. And then after that, they're going to think, well, okay, you need to start planning what's the longest timeline, kind of what takes the longest on all of this. Well, you've got so many compliance protocols that are pretty technical, well, very technical, a lot of differences between them. So understanding which one you want to work with takes a while. They all have very different fee structures right now. So going through that, understanding what exchanges they plug into, it all takes a long time. So you need somebody who can quarterback it, basically think of like a Gantt chart as to what takes the longest and how to finish everything all at once. And that's, that's kind of the high level of like how you do it, is just find the one right person.
That sounds pretty intimidating, actually. But where do you find? No, not at all. Where do you find the right STO vendors? Like you said, when you started out, there wasn't even a network. So yeah, is there a registry? I don't know. Is there a Yelp? I don't know.
Not really. I mean,
where do you find these? Where do you find the good vendors?
Yeah.
STO vendors?
So one of the problems is that just like any sort of nascent, fast-moving space,
Yeah.
there are tons of people in the space who say that they can do things that they can't necessarily do. And one of the problems is that then you're paying for them to figure out how to do it, and it gets considerably more expensive in that case, right? Which is one reason why, you go to a lawyer like Marc because Marc's done this before, right? He's gonna bill you for half the time because he doesn't have to learn how to do it all over again. And so, and especially when you're getting into stuff like the compliance protocols or the issuance protocols, you're getting into stuff where you, the issuer, are liable if they do something wrong. And so you need to be fully confident that these people that you're working with have done this before and know what they're doing and have the best product or one of the best products in the market. And it's, there's so much hype and there's so much hyperbole in this market that it's kind of difficult to sort through them unless you've been through it a few times.
So help me just so I can kind of get it straight in my head, right? So I'm used to traditional real estate deals. I don't know where I have the agent, the appraiser, the mortgage broker, things of that nature, right? It sounds like I still need those guys, but in order to tokenize, I need a whole new team, right? To So I need both. I need like a traditional team, and I need like a real estate tokenization team, right? And everybody needs to play nice together in the sandbox.
You have to think of tokenization like you're issuing a security.
Yeah.
It's no different, right? So if you're going to issue a security, you're going to go through a broker dealer, and you're going to need a securities lawyer, and you're going to need a custodial agent. So it's you know, as a former investment banker, there's just this process, and like Marc said, there's a Gantt chart of how you go through the process, and you know, you need to find. I mean, maybe one piece of advice is come to things like this and hear people like us talk, and just hear what's going on and kind of learn from being in and around the people who are I mean, you know, learning as we go. I mean, I'm learning every day about what's going on in the market and who's got the new protocols and who's doing what, and it's just an ever evolving market. So I think being a part of the community is a big part of it too. But it's not easy. It's certainly it's nascent. It's full of bad actors, or I guess we're starting to weed out the bad actors, right? And so you have to really be able to sense who's full of shit and who's not, frankly. Sorry, excuse my French.
Curse on my panel.
Sorry.
There are a few things that are changing depending on what you're tokenizing. So, for example, if you tokenize debt in a real estate deal, you know, and I'll let you elaborate on this in more detail, but you're going to be dealing with you know, different issues than if you're tokenizing the real estate and you still have like a typical lender involved, and I don't think a typical lender would really work in any kind of equity tokenized kind of equity deal. It depends who you're working with, I guess. But I think that's important to understand is things are going to change a lot on what you're tokenizing, because again, you can tokenize anything. The other thing is you're going to read a lot about like tokenizing actually helping bring down issuance cost and costs like that. That is very true in like 5 years. Right now, it is not cheaper. It will be cheaper. It's going to get better and better. But right now, it is just an added cost to do it.
Yeah. No, I have one more thing. Make sure if you really are going to do this, make sure you talk to your bank before you do it. Yeah. As I learned the hard way, I had a $5 million facility get pulled from me because somebody sent my banker an article that had me talking about doing our issuance, and they just sent me an email and said, your facility's pulled, we don't deal with anybody in cryptocurrencies, thank you very much. So talk to your bank, make sure you're very, very forward with them, and make sure you have good AML KYC on the front end of where you're getting that money from. Either if it's dollars or crypto, banks are terrified of cryptocurrencies right now, and they're still not ready for it. So you have to be very, very thorough in what you do in terms of how you approach your bank, but also how you approach AML KYC, because that's just the quickest way to get shut out, because banks talk to each other. They have lists of who's approved, who's not approved, who shouldn't be they shouldn't be doing business with. And we learned the hard way on that, and thankfully we had other facilities where we had explained this to them, but we learned that one the hard way, and so just learn from that mistake.
Yeah,
Yeah, actually, so dealing with the lenders opens up a really interesting paradigm, because lenders are also subject to a whole bunch of stringent regulations. And so theoretically, the compliance protocols that your tokens run on should actually make it easier for your lender to comply with the regulations that they need to. But it's an educational game, right? I mean, you can't just do it and then your bank finds out, and then again you're asking forgiveness instead of permission, right? But I think that, and it hasn't been done yet, but I think that there is a lot of opportunity on some of the deals that are coming down the line to start educating lenders on this sort of stuff. Right. And it's really interesting because Anthony Pompliano wrote this great article about how regulators will probably require everything to be tokenized in the future because regulators want to be able to regulate as effectively as they possibly can. And these compliance protocols give regulators a up-to-date, 100% accurate view into where all of these securities are trading and who owns them at any exact moment. And that makes their job so much easier. So theoretically, once these protocols are proven to be robust and dependable, regulators will probably require you to start issuing securities through them because it makes their job so much easier. You know?
Right. Yeah.
Prosecution futures, isn't that what one of the regulators called it? Like these ICOs? Sorry. I think there was a regulator or somebody like FBI or FinCEN or something like that came out and said these ICOs are just prosecution futures for us. There's a very clear trace of who bought these and who sold these, and so to the kind of the counter of that point, it's very clear who didn't follow the law,
Yeah.
right? So.
Yeah.
So 2 quick questions. Marc, you brought up that Gantt chart of listing out all the things you need to do. How long realistically does it take to tokenize a deal, and how much does it cost? Ballpark. I'm not quoting you or anything, but
Sure. Time frame. I mean, like the deals are going to be so different, but
Yeah,
time
sure.
frame. We always talk about the fastest you can kind of get this done, assuming is like 2 months. Except I always say, and I say this in every legal thing I do, I'm like, if everything goes perfectly, this is exactly how it's going to go, and it'll take 2 months, and it will not go perfectly at all. So what's more likely is that you're talking about 4 to 6 months, and especially right now, going 8 months is not surprising because the market's changing all the time.
Yeah.
Again, you want to build a compliance protocol into your token, and then you realize that there's another better one that just came out, and that you should probably use instead. And so there's just a lot of retooling. You get investor feedback, new investor feedback all the time. So that's one part of it. In terms of cost, it's going to depend on the firm that you use.
Sure,
Again, there's a distinction between, it's hard because you meld the cost of the actual deal together with the actual, security component of it. But I'd argue that if you make a good decision in terms of compliance protocol quickly, and you're pretty good at making decisions, that you could probably be out of this in probably $150,000. But I think you're much more likely to end up around $200,000 to $250,000. And if you've got issues with the compliance protocol and you got to restart your thing or two, wouldn't be surprised if you hit 300, maybe 350,000. I think if you're going above that, I think I don't think there's really an excuse to go above that.
Yeah.
I think there's been some that have. I don't know what you guys were at, and you're not going to say, and you shouldn't say, but being the first one, it wouldn't surprise me if you were above that. But I think now there's enough that has happened that there's no reason to go that high.
Does it make sense to tokenize now, or should we wait until the
So
prices go
here's the
down?
problem with that idea, because it's a chicken and the egg scenario.
Yeah.
If everybody waits, then there are no good deals to entice investors. If there are no investors, then there's no reason to tokenize.
Yeah.
So you basically have to attack at all fronts at once, right? You need to make sure, you need to be going to investors and saying, look, educating them, this is the new way to do things, it's more efficient, you're safer, it's cheaper for you to access this, there's fewer intermediaries, you have more control over your securities and your investments. You can change the allocations in your portfolio more quickly, right? But then with the investors, you need to be, with the issuers, you need to be telling them, this is the future, you need to be a pioneer, you need to be willing to take these risks, and these are the benefits, and compliance is going to become easier, and your investors will be the first ones who get to take advantage of this secondary market when it happens. And it's also a factor of going after the right issuers. I put together a team near the end of this summer to start talking to REITs. And luckily, some of the people on that team have some very deep connections at some of the top REITs in the country. And so we've been educating them on all of this and trying to convince them to shave off, a small piece of their assets, small to them, which is still hundreds of millions of dollars to us, and put it into a tokenized REIT vehicle. And a REIT is basically just a capital engine, right? An engine is just an air pump, and a REIT is just a money pump. You're just always pumping money in one end and out the other end. And so they constantly need to be tapping capital markets. And if you can show them that a new capital market is being created and they can tap that, then there's really no reason for them not to tap that, as long as you can convince them that there's no reason for them not to tap that. And if something like a REIT tokenizes, then you get benefits on both sides of the equation, because you have a high quality financial asset that's tokenizing, and then all of the typical investors who invest into REITs realize that a money manager who manages $30 billion in assets is not going to take this kind of a risk unless they were completely satisfied that it could be done in a completely compliant manner.
Yeah, right.
And then those investors find comfort in that and are willing to start taking risks on tokenized securities.
Right. Yeah, that's great. It's like the chicken and the egg. So liquidity. I'm coming right back to you, Henry. We hear that all the time, which is a benefit. Liquidity, 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 liquidity. That's one of the benefits. But in reality, we know that those markets are still, secondary markets are still being developed.
And the primary markets.
Yeah, right. Yeah. So what's it going to take for liquidity, real liquidity, to come into the real estate tokenization market?
Yeah, I mean, I think it's kind of a function of what I was just explaining. You need to bring high quality deals to market so that institutions and the typical investors in those types of high quality deals will enter the market. And it's an incremental process, right? Liquidity is not binary.
Right.
I think a lot of people were like, oh, okay, well now you have this token that's easily traded, and so it's going to be liquid.
Right.
But it's not. You don't just flip a switch and people buy it.
Right.
And there are so many different pieces that all need to come together. You need market makers to facilitate the liquidity, but the market makers themselves don't provide liquidity because a market maker's not going to buy your securities if they can't sell them on the other end. They just exist to make a spread between what they're buying them for and selling them for. They're not providers of the demand. Exactly. So there's all these different pieces that you need to fit together to create a truly liquid secondary market.
Yeah, good.
I'd also add a piece that isn't focused on very much, which is informational. You know, you look at public markets, part of the reason that they're so liquid is because you have, you know, quarterly information, and you've got, you know, material information that gets provided in 8Ks, you've got audited financial statements. I think that any company that tokenizes really anything needs to be providing information to the public. It's just, I think it's a waste of money and time, frankly, if you're not going to do that. You need to be prepared to, it doesn't need to be perfect. I'm not saying that you need to provide, you know, I mean, GAAP compliant would be perfect, but even if you provided quarterly financial statements that were not done in accordance with GAAP, anything that gives more of a picture, if you give an update, I mean, for the real estate property that would actually be willing to give an update when a tenant leaves, that would be like groundbreaking, but frankly, it would provide so much confidence in the trading in that token. And so, you know, it's going to take time to figure it out, but I think private issuers really need to work on what information I'm going to make available and plan on making information available, because until you have that, there's no way for decisions to be made in terms of buying and selling anything.
Well, and that's an interesting piece of it too, is one of the things that we wanted to do. My background comes from, you know, residential mortgage securitization, and you report monthly in that world. So we were always contemplating just giving out a monthly report, and everybody kind of kept asking us, well, how are we going to know what the value of the underlying assets is, and what's the value of the token? Well, it's in the report. Like, I'm going to tell you what the value of those assets are every month. So I think that's a really interesting, like, we'd always thought about that as just kind of second nature, but I think a lot of people in the crypto world didn't ever think of that. Like, oh yeah, I'm just working on my project, and I'll tell you when there's an update if it's great, and if it's bad, I'm never going to tell you. So I think it's an interesting value proposition of actually having real reportable data for people to play with.
I think a lot of people in the real estate world don't think about it either, right? Because I mean, like, you know, I've worked on billions of dollars of commercial real estate, and most of those GPs are not providing regular financial updates to their LPs either, right? So it's like this paradigm shift in how all these different issuers have to think.
Yeah, I could talk to you guys for forever. I mean, I feel like I can talk to you for the next couple of hours, but I know you don't have time like that. But anyway, just a couple more quick questions. LA is like I read somewhere where LA is like a $2.5 trillion real estate market. And yeah, we're seeing a lot of deals in New York and other places of the country. I mean, and there's a lot of valuable property here, areas, Beverly Hills, Malibu, etc. When are we going to see a STO real estate deal in Los Angeles? Will it be in 2019? And do you have any predictions for 2019 as far as the market, how it will evolve, what we can expect moving into next year?
We did one in 2018, so
Yeah.
that was the first. No, I'm kidding. You know, from a commercial perspective,
Yeah.
you're probably way more
Yeah.
suited to answer that question. But I think you'll start to see some resi deals come. I think resi deals are probably the second asset class. I think resi funds will be the ones that'll follow on. I think we were probably the very first, and we will be the first for a very long time,
Yeah.
because I think people just are going to learn from our experience
Yeah.
and say, well, let's let the commercial guys do it, because it's much more tangible, right?
Right.
There's one asset, or there's 3 assets, not thousands like we had contemplated. So you're probably better suited to answer that question, but I would hope it's soon. I don't know.
I mean, absolutely. So, so one at Slice, we're looking at some deals on the West Coast, a couple in LA as well. So hopefully we get those done next year. But there's also this competitive side of me that's it's like, I don't want to just match what New York has done.
Exactly.
You know, I want to blow them out of the water, right?
Yes.
I want us to be the first $100 million,
Right.
fundraise. I want us to be the
Yes.
first tokenized, diversified public REIT.
Yeah,
You know, and
love
so
it.
that's. I think that we'll see that next year, and I think that it'll come out of LA.
Yeah. That's great.
And I think we're all kind of working hard to make sure that
Yeah.
happens.
Yeah.
I don't have anything to add.
Got it. Well, thank you guys. We really appreciate it. Can we give you a round of applause? I know there are probably some questions in the audience, so I think we have time for maybe 2 or 3. So yeah, I don't know if you could just stand up, maybe talk loud, and tell us your name. Yeah, just yell. Tell us your name and where you're from.
My name is Ian. I'm from Delmont. Looking from a perspective of someone who's like looking at a rental property that they save up a down payment and buy it, is there like an alternative opportunity one day for a tokenized real estate for that person, or you have to be like an institutional accredited investor?
For if you're going to buy it, or if you want to tokenize it.
Is there an opportunity, instead of me buying a rental property, to buy a tokenized property that I could make money with?
Yeah, I think so. I mean, the one problem right now is, you know, if you're not an accredited investor, the options for a institution to offer you something is limited, right? It's no different than traditional securities laws. You have to either go through public securities, or you're kind of not given access to these private securities. So I think until there's a regulatory change on that front, you might be limited, but I would hope that there's a public REIT that's tokenized, and that would potentially give you access to a diversified pool of rental or kind of otherwise REIT eligible assets. But once you kind of get out of that REIT eligible asset, you know, into something more distressed or a little more yieldy, those are typically private securities, and unfortunately the regulatory regime we have right now limits those to accredited investors.
Yeah, and I'd say let's talk again in 5 years. And then, that being said, there is a company based on the West Coast, and I'm not vouching for them. I don't know, frankly, too much about them. I think it's called Quantum or Qtum or something like that, Quantum, that is working on something similar to that. I think they're looking to actually tokenize residential properties that people live in. Or tokenizing the, okay, there you go. So something you might want to look at if you're interested in that is looking at Quantum.
Yes, sir. Eric? Yeah. You just tell us your name. Oh, yeah.
Sorry. Eric, I'm from Virginia. But the other question is actually for you, Marc. I'm not going to hold you to this, but For the cost range, where was the lion's share of that money being spent between the 250 and
Yeah, so a few things. One, and it's why I pointed to Henry right away, is that using your lawyer as the person to drive everything probably doesn't make economic sense. But there aren't many people, frankly, who know the ecosystem, not to pat myself on the back, but as well as me, other than a few people, Henry being one of them. So, if you use, somebody like him who really knows what he's talking about, I think that can actually help your costs quite a bit. So part of that was simply saying, hey, Marc, I want you to be on calls to talk through things with the different compliance protocols. I want you to negotiate agreements with them because we're going to contemplate a few of them. Then there's things like this client really wanted to contemplate a lot of different possibilities as to what they were going to tokenize. So they might tokenize a revenue stream or profit share or equity directly. As a result of that, we built very complex agreements that contemplated all of these possibilities. And then we'd enter into them, and then we needed to amend them because it was like they talked to investors and completely changed their plan as to what they're going to do, and it was something that we couldn't have thought of in a million years and wasn't contemplated in that. So now we're drafting an amendment. They're going to all the investors to go ahead and have that amended, or whoever it is, and same thing with advisors. A lot of that kind of stuff. So, the actual core work, that's why I kind of said, that can actually be done somewhat efficiently. I mean, you do a typical 506C offering, I think it's very realistic to keep that at $50,000. Getting a PPM together, getting a purchase agreement together, I think that can be done. Maybe 60, maybe 70, but nowhere near that. It's because of the complexities with the token and going back and forth with stuff that you get the higher costs.
And it's also because it's early days. Just the costs in general should come down. It should come down a lot.
Okay, yeah, that's what I'm
Going back and forth is all because of the early days.
Right.
So, yeah, I think you agree.
Yes, sir.
For the investors to actually take interest in real estate as far as tokenization is that it's like a share. But shares are actually inherently centralized. So what is it about the decentralized environment that you think will empower investors to be able to kind of bring that same liquidity to the market that we're seeing with all this tokenization? And because of the inherent problems of decentralization as well, how is it that institutions will agree to either tone down regulation or make the regulation upfront so that it's say I can transact a portion of this real estate venture with my fellow investor from a syndicate's perspective?
So the interesting thing about new technologies is not necessarily the incremental costs that they save us when we implement them. They're the way that they allow us as human beings to change the way that we organize and interact. And so the interesting thing about decentralized technologies in particular is that no one owns them. And so you can have multiple institutions that otherwise would be trying to capture a piece of the value chain for themselves, which you end up with the current system, which is many, many walled gardens that don't speak to each other very effectively, which then creates tons of opportunity for several layers of intermediaries. Now you have these decentralized systems which work better than the existing systems, and you have all of these different stakeholders who benefit equally from supporting that system. And so you don't have any individual stakeholder that is creating their own walled garden, because then it actually decreases the benefit that they get from those systems. So that's the biggest reason that I think that we're going to move entirely to decentralized systems, not only because they're better, but because they disincentivized that centralization that you see in the systems that exist today. And then you can build more centralized systems on top of them, right? The compliance protocol is, Securities or Harbor or whatever. They have a protocol on top, which is, it's software that is controlled by one company. However, it speaks better with all of the other security tokens and all of the exchanges and all of the individuals who are on the blockchain, because the underlying architecture is all in the blockchain. But you can build this top layer that gives the institutions that comfort that they have control and that they have compliance and that they are protected from the otherwise, insanity that might be going on below.
So like the decentralized market sort of like, sorry, go ahead, I'd like to hear what you have to say.
I was going to say, first of all, I can't be as deep as him. That was pretty deep, especially that first part. That was pretty good. One of the most fun projects, I like to try to get creative with this stuff. So one of the most fun projects that I'm working on, and granted it is probably one of the most expensive, is decentralizing the entity. So what did we do? We grabbed a Delaware LLC. We elected to have it taxed as a C Corp so that we didn't have to deal with the tax issues of a partnership. We then made it member managed rather than manager managed, so no central control. Now all the members are actually managing the LLC. And so now you actually have a decentralized entity with decentralized decision making. We also are including utility in our security token by essentially saying that any security token holder can actually buy, this is like a loyalty point related product, buy some of these loyalty points at a discount. What that essentially does is it drives up the value of the security tokens for certain holders who actually want to hold that security token so that they can receive a discount on the product itself. And so you're actually going to have kind of a certain play there in the securities where I think in certain people's hands they're going to be worth more than in other people's hands. So I guess my point is you can kind of have fun with it, get fun, get creative, and create something decentralized in a normal ecosystem.
Now, afterwards, if you can, that would be great. We have time for one more question. I'm sorry. Yeah.
What stops somebody from forming a company? What stops somebody from forming a company overseas, not selling to U.S. investors, but they would sell properties in the United States to people from other countries? So it basically has nothing to do with the SEC. I asked just a few lawyers, they all said that it's perfectly kosher.
Well, I think that there's a few parts to this. One, so you're saying foreign investors buying U.S. real estate? And so you just literally just said what Slice does. And that's what we did with Slice.
You don't need to deal with the SEC because you have no business with American buyers.
And that's what I made sure would happen. But there are a few parts to that. So first of all, yes, that's what we're doing with Slice. No U.S. person can be involved whatsoever. And we didn't need to do that. There were certain reasons we did it. You didn't need to do that. We just chose to for certain reasons, and that was an issuer choice. But no, you don't need to. But people, I do want to point out, people take that a lot more lightly than what it actually means. So what I mean by this is, if you go ahead and you issue a security offshore, you don't build in the right compliance into it. That security ends up back into the U.S. Without going into the detail of how Reg S works, you've got different categories and different restrictions that you need to impose on securities based on the category that you fall in under Reg S. But Reg S has preliminary notes to them. They're essentially overarching ideas. One of the preliminary notes says that you cannot use Reg S to evade registration of a security. If you take a security and you issue it as a foreign issuer, you sell it to other foreign people, that foreign person is going to go list it on an exchange that as an issuer is available to any U.S. person at any point in time, and that U.S. person is going to go and buy it there in all likelihood. And a day later, that token ends up back in the U.S., you've essentially acted just to evade registration. You use that offshore person as a straw man, essentially, to get it back into the U.S., which is exactly what those preliminaries are trying to avoid. If you do...
It could be a thing that you will specify cannot sell it to the United States.
And that's my point in terms of if you build compliance into the token properly and you don't let that happen, then yes, you're completely right.
Yeah.
Yeah, exactly.
There's a whole other issue of the tax of foreign entities owning U.S. real estate is like a really big but like it's a huge tax issue, and I could talk for hours on that, and I will not bore everybody on that, but it's just it's a big issue.
Right now, Chinese people cannot export legally more than $50,000. So technically, if they want to buy real estate in the United States, the only way would be with token business. Because they couldn't buy a whole building for just $50,000. 500 Chinese characters decided to put $50,000, so they can.
Well, yeah, the 50,000 is getting it out of China. A lot of people have their money in Hong Kong, and it flows through that way. I mean, it's just a common way to get it out of China if you can do it. But yeah, no, look, there's ways you can do it. It just has huge implications legally and tax wise too. It's just there's nothing stopping you. It's just you have to make sure you abide by the rules.
Well, again, thank you guys for coming tonight, and we want to thank our sponsor, Spaces Co-working Space.